And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the Hump Day edition of The Real Investment Show. It's also Q&A day with Danny Ratliff, so we'll get into all your questions this morning. So jump into chat, post your question. Danny's going to be kind of keeping a watch on those and getting those kind of lined up for us, and we'll get into those here in just a second. Just kind of a quick update on earnings season. So far, earnings have been as better than expected, beating estimates. Profit margins are running at about 13.5%. That's an all-time high for profit margins. So again, we keep seeing profit margins improve for the S&P. Now this is as of reported so far. Now we still have a couple of weeks of earnings left, but we're getting pretty far. We're about 50%, 60% of the way through earnings season right now. Lots of companies reporting over the last night. Today we'll talk about Eli Lilly and Novo Nordisk here in a second. Again, the majority of that improvement in profit margins coming from information technology and industrials. That's where the most profit margin's been growing. Most of the earnings growth is still coming from the technology sector in general. So we're still seeing that kind of story play through. Again, when companies like Microsoft and Apple and Amazon are reporting, that's where they're just so large that's where just a lot of that, of the overall earnings growth is still coming from the technology sector itself. But speaking of earnings, again, we've got this afternoon after the bell, we're going to have Google. So we've got some mega cap earnings coming in this afternoon. That'll be moving the markets tomorrow. In the weight loss space, which is I love the GLP-1 space. I just think it's fascinating. It's just a sweep that's taking over the country. If you've been on social media at all, it doesn't take much trolling around before somebody comes up with some high protein recipe. Brent knows this, but everything you watch now is like, hey, here's a high protein recipe. We need more protein. You got to get more protein. But this has been a very interesting shift with kind of the country over the last couple of years in particular. We've started, ever since really GLP-1s came to market, we've seen this kind of push towards being healthier, eating healthier. For instance, Chipotle Mexican Group, CMG, which is trading at tech stock valuations, is no longer a growth company. And we're starting to see, even in their numbers, we're starting to see slower foot traffic, those type of things. It could also be the fact it's a $20 burrito. But maybe people are starting to think about eating a little bit healthier. Anyway, but there are winners and losers in every space. And with the GLP-1s, this is the weight loss drug, right? This is the semaglutides that help you basically just not want to eat, is how those work. Novo Nordisk reported earnings, very poor guidance, stock under a lot of pressure. On the other hand, Eli Lilly, their direct competitor, just reported blowout earnings this morning. Stock's going to be up about 8%, at the open this morning. So again, just a tale of two cities, so to speak, in terms of kind of what's happening in that space. But it's a fascinating space. In healthcare, the two stocks that we really like a lot, we've owned for a long time. We do own Eli Lilly. We do own AbbVie, which is primarily the maker of Botox. Again, kind of our focus has been on healthcare. Yes, we're all getting older, but we're also getting more vain as we get older. So now we want to be skinnier and look beautiful. So we need to have GLP-1s and Botox. So this is just the trend, and I'm going to ride it for now anyway. That's just kind of where we are. All right, let's talk a little bit about what you need to know before the bell this morning. Then we'll get into the Q&A with Danny here in just a second. Yesterday, the market sold off pretty decently. So we were looking to open up yesterday morning. We were talking about that. We were just kind of approaching all-time highs, kind of pushing up into that resistance. Yesterday, the markets kind of opened up in the mornings. Everything's looking fine. Then immediately, we started getting selling come into the markets. And the markets sold off pretty sharply. We were down about 1.5% yesterday. Excuse me, got the hiccups. Down about 1.5% yesterday. Touched the 50-day moving average, bounced off of that into the close. We saw buyers come in. Again, this has kind of been the story now for a while. Anytime that we see the markets come down to around this 50-day moving average, we see dip buyers step in. Even on the bigger drawdown we saw last November down to the 100-day moving average, keep seeing dip buyers step in. So anytime there's a pullback in the markets, these dip buyers have been ready. This is mostly retail investors. They're buying these dips. Just like we're seeing in gold and silver, we're seeing this buy the dip mentality, which is fine. That's what we're supposed to do, right? We're supposed to buy, kind of reversions in markets. Just be careful of this because, eventually one of these days buying the dip's not going to work and you're going to get caught on the wrong side of the trade. But for right now, it's working, so we don't want to ignore that. Markets are looking to point up a little bit this morning at the open, trying to reclaim the 20-day moving average. We'll see if that happens. Yesterday's most of the sell-off yesterday was in the mega cap stocks. It was in NVIDIA, Microsoft, and Google, and those guys. This morning, those stocks are rebounding a bit. But there was, if you looked at the heat map yesterday, it was definitely a day of valuation. Value stocks were definitely outperforming the Walmarts, the Costco's, the Procter & Gamble's. Those were the energy stocks. They were doing well yesterday. The big cap tech stocks under a lot of pressure yesterday. Just we're continuing to kind of see that value growth rotation in the markets, which tends to last for a while, and so that's why we were talking about early this year about adding value stocks to the portfolio because we're starting to see that kind of early rotation. Our factor rotation model is pretty much tilted to value right now, and that will eventually change. So we're actually getting fairly close though, because value stocks are now, that whole kind of sector is getting much more overbought and extended. So we're likely getting set up here for a rotation back into growth at some point here in the next month or two. But again, February tends to be a bit of a tough month, so we may see a bit more of this kind of volatility over the next month or so. We are watching the volatility index fairly closely, and we continue to see a kind of this, as we talked about recently, kind of this rising trend in volatility. We saw that kind of pop up yesterday, still well contained. We're trading about 17 on the volatility. But again, just as we kind of move through the month of February, get past these earnings for the most part, there is a risk here of a little bit more sloppy trading. Nothing major, but again, February just tends to kind of be a weak month overall anyway, and we're kind of set up going into February with the markets already a bit overbought here. That kind of sloppy trading we're seeing right now may continue for the next couple of weeks, next 2-3 weeks. So again, just be careful with your allocations. Don't take on a lot of risk bets because again, we're just kind of in one of those periods of the market you just want to be a little bit more cautious about. Again, nothing to be concerned about, but just be aware we can see a little bit more of the sloppy trading, kind of this rapid rotation between sectors and markets. And one day it's tech, one day it's energy, next day it's tech again. So be careful making big moves in your portfolio until we kind of get through this period and get more of a steady trend back into the markets overall. Okay, that's what you need to know before the bell this morning. We'll come back, pick up with Q&A with Danny Ratliff. Don't go away.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And all right, welcome back to the show. I just have to change sets there real quick. Just get ready here. Danny, good morning. How are you?
Good morning. Doing great.
Awesome. So let's get into some of the Q&A this morning. What we've got going on?
Yeah, we've got a lot of questions coming, so I'm trying to keep up here. But I think you in the market update you talked a little bit about the rotation maybe that we're seeing. Yesterday we saw a bit of more of the value play overperforming, and in fact, if you look at a heat map, it was probably a little bit encouraging in some ways that while you saw tech down, a lot of the other market was actually green.
Yeah.
So do you think that maybe it's time to start lightening up on the Mag 7? Are we late stages? I mean, I've heard a lot of outlooks that are suggesting that we're kind of middle stages right now. If they're equating this to, everybody wants to go back and equate this to the .com bubble. Mm-hmm. And do you think that that's where we are? Or do you think that we're further in the game? And would it be time to lighten up those positions in that Mag 7?
Well, let me ask you a question.
Yeah.
If I told you technology was one of the cheapest sectors of the markets, would you be selling tech stocks or buying tech stocks?
Be buying them.
There you go. Okay.
Yeah.
What's your next question?
All right. So in kind of that same vein, do you believe AI is destroying software profit margins?
Yes. But actually, I just posted a tweet on this morning. If you take a look, so again, when the media grabs a hold of a narrative, right? We tend to run with that, whatever the narrative is. Right? And again, we just tend to push things to extremes. It's like, okay, AI is eating into software profit margins. Of course it is. It's going to eat into anything. AI is going to eat into everything, right? There's nothing AI is not going to eat into.
With the exception of probably efficiencies, right?
No, it's going to eat into efficiencies too. It's going to make even things more efficient, right? So again, whatever you were doing before, you're going to be able to do faster, cheaper,
Well,
better.
correct. Just like even in the .com internet,
correct.
We're able to utilize things, adopt them, and do things much better and more efficient.
Right. And so, yes, it's certainly happening with and this is specifically software as a service businesses, and these are companies like Now and others that are being impacted by what's happening in that kind of space. But Brent, I got a couple of charts here for you. So, first of all, so when these narratives kind of catch hold, we just start kind of just running with them. And this is going to be bullish or bearish, right? So, we just saw this with precious metals. Precious metals were going up, and so we all started piling in. The vast majority of the trading in those is occurring in options. So that's highly leveraged. And again, we come up with a narrative for that. It's all about debasement, which isn't a real thing. But we're just kind of run that to the moon, expecting that price rise is going to continue forever. And same thing with software as a service kind of industry, is that now we expect that every software as a service company is going to go bankrupt, right? And that's not. And so as investors, now I'm not making a recommendation that now is the time to buy software as a service type companies, software companies. But I think this is where you start paying much closer attention to the companies in this space, because AI is going to certainly impact them, but it's not necessarily going to replace these companies entirely. Now, some companies may actually go away, and this is going to be the hard part. This is much more akin to what we saw in the dot-com bubble, where people expected every company in a sector to just go away. And it's just all these companies are going bankrupt. AI is going to do all this. Maybe that's the case. Probably not. But this is where, as investors, that we need to take a step back, get away from the narrative for a moment, and start looking at some of these companies. As a business, software as a service is now as oversold as it's been at pretty much about any time on record. So again, these stocks have just been under a tremendous amount of pressure. Some of these stocks are already down 40, 50, 60%. And then secondly, Brady, you can bring this chart up. This is the value, this kind of sell-off has compressed the valuations of these companies to kind of some of the lowest levels we've seen since really kind of going back to the big sell-off that we saw in 2022. And again, back in 2022, we had AI back in 2022. Everybody thought that, this kind of whole market was over. And then that was, and remember, NVIDIA was trading like at $10 a share or something. We just completely crushed all these companies. And then of course, everything came roaring back. But the point, what I'm saying is, if you take a look at a company like ServiceNow, NOW is the symbol. Again, no recommendations here, not buying these right now, but they are starting to come up on our radars to start paying attention to, because here's a company that trades at a PEG of 1 and a forward PE of 21 for a tech company, and for a company that's growing, is estimated earnings growth over the next 5 years of 20% annually. So if I can buy a company that's growing earnings at 20% a year with a PEG ratio of 1, that's at least worth paying attention to. Now, will ServiceNow go completely out of business? Maybe, it's possible. I don't know. But as investors, we kind of get trapped into these narratives where these things are going down. It's like, oh, they're all going down. It's all going to be over with at some point, and they're all going to go to zero. There will probably be some of these companies that do. But considering, as another example, Salesforce, CRM, I know thousands. I mean, we use Salesforce in our company. My wife's company uses Salesforce. Everybody I know pretty much uses Salesforce for CRM in their company. Should we be starting to pay attention to buying things low, right? Because our job is supposed to be to buy things low and sell things high. But we, as we've talked about before, we typically chase whatever's going up and we buy that. We don't want to look at the stuff that's going down. But this is where money's made eventually. And again, no recommendations here. I don't think the sell-off in these sectors are over yet, and I think we need to see, give this a bit more time to stabilize and see kind of how earnings work out, blah blah blah. But I think these are where the opportunities start to form to really make some money in the markets. And again, and if you could go back in time to 2022, everybody thought Nvidia was dead in 2022. Stock was down about 90% from the peak. If you could go back to 2022 right now and rebuy Nvidia back at 2022 levels, would you do it?
Absolutely. No doubt about it.
Right.
All right. So a lot of questions trying to keep these in the same kind of lane here, but we'll jump around a little bit. So ERCOT. So for you guys that don't know, that are not in Texas, that's the Electric Reliability Council.
Oh, I thought that was Disneyland.
Of Texas. Well, yeah, not that one. They are responsible for keeping our lights on here. So question I think goes a little bit deeper than this. So will ERCOT in Texas begin to maybe pump the brakes on potential build outs of data centers? And do you see other agencies / states following suit just with the lack of infrastructure that we have?
You're going to have to.
Yeah.
I mean, it's not like, for instance, if you take a look at where the data centers are being built, like Texas, Idaho, up around North Carolina, that area, there's just big clusters of data centers all getting built. And in Texas, there's just a huge, I can't remember the exact number, but I think it's 200 or 300 or 400. I mean, it's a lot of data centers all getting built in Texas right now. And we just simply don't have the power to generate it. So they're going to have to, and I've talked about this, but I was talking about this 2 years ago, that at some point we are going to have a public-private partnership between the government and private industry, and particularly private utility companies, to build out this infrastructure. In other words, the government is probably going to have to step in and provide additional funding to build out infrastructure, power grids, those type of things, to make sure that we have the connectivity for all these data centers.
Quick Google search. Mm-hmm. Texas has 570 already operating, 442 in the works.
There you go. So I knew it was a lot.
Give or take. That's a ton. Well, we have trouble just keeping the lights on in a storm. So, it's infrastructure is certainly a big deal. Now, we've talked a lot about this where it will have to be that public-private sector. Mm. Public has so much debt. The private sector is going to have to come in. There's probably a great opportunity at some point to really profit from that from an investment perspective.
Oh, absolutely. And if I was the government, if I was President Trump right now, I would be pulling the Hoover Dam move, right? Yeah. Where I would be, saying, hey, look, we're going to work with you. We're going to help build out these power generation, complexes, energy, and electrical grids, et cetera, and we're going to collect fees from that. So, yeah, we're going to use debt to help fund this stuff. Utility companies are going to build it. We're going to help fund it. And then we're going to collect fees off this for the next, 150 years. And you get a really profitable, productive investment into the U.S. economy. That increases national security. So, I mean, and you're going to increase economic growth on top of it, right? So if I was President Trump, I'd be doing that. I'd be like pushing that agenda right now.
Well, and I think they're going to inevitably do so. I mean, if you look at where tax credits are, I mean, everybody always talks about, they give the rich grief for not paying a whole lot in taxes. Mm-hmm. And in general, they're using the tax code, right? So, I mean, if you think about the government has incentivized investments in specific areas, housing, energy. So it'll very likely be the same case at some point that you would think they're going to have to make a bigger push to encourage additional investment, so the private sector can certainly kind of pick that up.
Yeah. Just real quick, there was a comment that some more wind and solar wouldn't hurt. It wouldn't hurt. The problem is it's not efficient enough. And, for the type of power gen that you need for AI, you need, first of all, you've got to have very steady supply. Wind and solar is not steady and consistent. And you need something that is extremely efficient, which is why a lot of these data centers are turning to either nuclear or natural gas for their productivity, for their electricity generation, because it's steady, consistent, and reliable. Go ahead.
Well, and they're an eyesore. I mean, let's be honest.
Well, and then they also use a whole lot.
They all are.
You use more petroleum to build a windmill than you actually get out of it.
Well, do you know how much petroleum is needed just to keep those things going and lubricated?
Oh, yeah.
To continue to turn?
That's what I'm saying. The payback on that is not really that beneficial.
I don't think it's as green as we all think.
Right.
And you drive out to West Texas or many of these places where there are just wind farms and solar farms everywhere. I mean, it's littered the landscape.
Look, it's fine. It's fine with it. I mean, if you want to do it, it's fine.
Yeah, of course.
I'm just saying that from the power gen's perspective, they're just not. They are not efficient enough to meet the power demand needs that we've got to have. You've got to either do nuclear or natural gas to some form.
All right, so this is a great question, kind of stemming from that. What do you think of critical mineral push by the government, and what should we do from an investment perspective? Right? I mean, we're hearing critical minerals, in Ukraine and all these places. We're seeing a larger push from the administration in many ways to secure assets. I mean, if you think about that, Greenland, think about even what just happened in Venezuela, maybe not as what we'd consider a critical mineral, but certainly critical, oil. Do you think there's a bigger push towards that?
Yeah, absolutely. As you push more into AI and all these type of things, these kind of critical minerals are become that much more important. So, but again, these things are going to trade, in extreme ranges. We're gonna move through cycles. These things are gonna have extreme ranges, those type of things. We're gonna have new discoveries of things. So you have to trade these with a bit of understanding that these aren't just going to go straight up over time. You're going to have, these kind of booms and busts and cycles. Good example, Albemarle is a really good example of this. They're a company that mines lithium. And when we first came out with EVs, everybody said, oh, we're going to have, all this demand for lithium, blah, blah, blah. So everybody was buying, lithium type stocks. And then they had a huge run up, they had a huge crash, and now they're starting to rally again. Kind of we go through these narratives. So just, as with every investment, yes, rare earth materials, those type of things are going to be very critical to national security, to operations and the country over the next, decades as we continue to build out more robots and more EVs and all these type of things. But just also understand you're going to go through boom and bust cycles, as is always the case in these areas. So don't forget to take profits, manage your risk.
So we were just talking about fundamentals to some extent, looking at PEG ratios, where companies are. So there was a comment that says, I believe stock price and direction tells us something. Why even look at these businesses because they're cheap? Don't agree with that approach. And I think that's kind of a big theme that we see right now, right? Everything's been based on momentum. We have seen this technical push. But at some point, understanding a balance sheet is going to be a really nice feather in your cap, especially when the whole market is trading ETFs, it seems like these days.
Yes.
So fundamentals do matter.
Fundamentals matter a lot.
Yeah.
And, eventually at the end of the day, ETFs are fine. Nothing wrong with them. But, again, you're going to get average returns over time. And the problem with ETFs is that you lose selectivity. So it's a good example today, right? If we own Eli Lilly in our portfolio, but we also own in our ETF model, we own XLV, which is the healthcare sector, which owns Eli Lilly and Novo Nordisk. So our equity portfolio will benefit from owning Eli Lilly today and not Novo Nordisk, but the ETF will get the average performance of those two stocks, right?
Yeah.
So, so ETFs are fine. To buy a basket of stocks, you can get average performance on the time, but you lose out on the selectivity of owning, the winners versus the losers, because the basket's going to own the winners and the losers. So you just get the average performance of the group. And nothing wrong with that, by the way. I mean, if you're okay with average performance, that's fine. If you're trying to build wealth over time, you want to be more selective about where you're investing. Did that answer the question?
Yeah, no, more or less. So I elaborate a little bit on the end of that, but thank you.
Sure.
So metals, you guys are a little quieter today, but in general, I mean, obviously people are concerned, right? After this many people are still sitting on a lot of profits. What do you do at this kind of point? I mean, we're kind of at a critical juncture. We've seen prices drop quite a bit. CME has changed margin requirements, may do so again. Volatility will likely breed more of that type of kind of oversight, I would say. do you still think this is a great time to maybe reduce some exposure, or do you think we're really oversold and likely going to get a bump?
You're pretty oversold. You're going to get a bounce. And this is what I was saying earlier with buying the dips. As soon as things correct, like when you have a very sharp correction in something, you're going to get dip buyers to come in. They're going to buy call options, those type of things. Because again, you just had this huge run. Right? So now you had this correction. It's like, oh yeah, well now I've got this correction. So I just had this huge run. So we have recency bias. We're gonna get this huge run again. So only thing you want to be paying attention to right now is previous resistance levels. So, kind of start looking at charts and saying, okay, as these prices bounce, what's going to happen is you've got a lot of people that were buying silver right at the peak, right? They literally were buying silver the day before the crash. And so now they're down 30%. So now this is what's called a trap long. And so you've got people that are trapped in the space. And so as this bounces, you're going to get people wanting to exit. Now, also at the same time, you have the institutional players. The institutional players have to short the market when it's going up. And so because they're the ones, so when you go to buy a call option, somebody else has to sell somewhere, right? So the institutions are arbitraging that trade to create that call option for you to buy. So I'm buying a call option on silver, that's great, but they've got to be short that call in order for you to have it, because there has to be a buyer and a seller for every transaction. So somebody's got to be short when they're creating the long. So when the price dropped last week, that 30% decline, they closed out a bunch of those shorts. And that's where all the market's manipulating the market, blah, blah. No, they were just closing out those arbitrages. And now they're going back long as well, because at this point, they've got to start, as you start buying more call options, they've got to start shorting again as this price rises. And so the question now becomes next is, where does that price rise fail? And you get the next kind of correctional move in the markets. Can it make it back to all-time highs? Maybe. But I think that's kind of your good mark right now. If you're long silver or you're buying silver here, it's fine. You need to watch those previous highs, and if you can't get through those, if you fail before you get to those all-time highs and you get start to get a technical breakdown, then you want to start becoming much more kind of concerned about your positioning. Because again, even with that correction, these things are still extremely overbought on a monthly basis. You did not correct the big overbought conditions in these metals that we've not seen from historical perspectives since like the 70s, and just extremely overbought conditions. So again, just kind of, this all becomes a technical play right now. So just kind of watch your prices.
Yeah. All right. So we talk a lot about discipline, sticking to a plan/strategy for buying and selling in your portfolio. How much do you need to lose before deciding you need a new plan? I mean, I think that varies. I mean, you need to look at, number one, the big picture, but also having that discipline will dictate what you should do technically. I mean, if you think about this, that discipline or the plan going into it should provide a whole lot of guidance as far as what needs to be done. When we talk about this, we even go a little bit deeper when we're talking to clients, in the sense that we want to build out a plan to understand what is the hurdle rate, what is the overall goal that you need to reach your objectives and goals. And you should know that within your own portfolio if you're managing it. And so you need to also understand, what is your risk tolerance? So there's a time you do need to cut bait. You may also want to deviate from time to time based on data. I mean, we may look at something and say, wow, volume's really messed up. Was this a one-time deal, or is it very oversold very quickly, likely for a nice pop that you get out at that point in time? But I think it's a great question. I don't know if you want to elaborate on that at all, Lance.
That's good. Yep.
Okay.
But it's a good question.
Yeah, no, I think it's a really good question. Let's see here. Sorry, guys, talking and reading is not my forte. You can only multitask so much. There was another good one.
So again, real quick, just on this, we got the guy in chat. This was not, stop it. This was not a forced manipulation to save the banks. That's not how any of this works at all, period. Stop it. This is exactly the narratives that I was reading. I quoted to you on Monday here on the show. I read you the article I wrote on January 5th saying that when the price correction happened, there was going to be all of these comments coming out by the perpetual purveyors of doom that this was all manipulation of the market and all this. That's not how the markets work. You have to have short players in order to have long players in the commodities futures markets. They are going to cover those shorts when they get down. This is not to save the banks. That's how they make money. And this is why they make money way more often than retail investors do, because they're the ones arbitraging those trades. So stop it. And no, silver is still down like 20% from its peak. So it's not down 10. And yes, it's been bouncing for the last couple of days, as would be expected, because you're coming off an important level of support. You've got your 50-day moving average running right along where we bounced on Fridays. And that was where JP Morgan was set up. At the 50-day moving average, they stepped in and covered their shorts. They were the buyers in the markets when everybody else was paying. That wasn't to bail out JP Morgan. They are just fine. Anyway, go ahead.
Well, are we seeing something similar to this? Are we seeing?
You hit your mic button.
I did not, Brent. Only so many buttons here. Are we seeing something similar in Bitcoin?
No. It's that's a little bit of a different market.
Okay.
You have some of it because you do have options trading on that, but because you have leverage. But no, it's a little bit of a different market. No, that's just that is a problem right now that Bitcoin's a bit different because you have a huge number of people that are just long-term holders of Bitcoin. They are just not going to sell Bitcoin. So what drives the Bitcoin market more than anything else is the fringe traders that are sitting on the outside trading Bitcoin, et cetera. And because you have these big, large institutional players like MicroStrategy is a good example they're not buying or selling right now. They haven't been buying Bitcoin. They haven't been selling Bitcoin. So they're not moving that market. So what's moving that market is simply what's happening on kind of the fringes.
Yeah, no, absolutely. So had another great question kind of on a planning aspect. So over 65, still working, should you jump on Medicare? And that's going to be totally dependent on if you have to. Number one, you have to be on a creditable plan. So that means that your employer needs to have 20 or more employees. You can see some pooled plans where you may be with a smaller company. I would check with HR, because what's going to happen is you're going to have to get a letter from your HR group and benefits group stating that you are on a creditable plan. Therefore, Medicare will still give you your one-time guaranteed insurability. You'll have a special enrollment period after age 65. So let's say you retire at 68. You're going to have an 8-month window at that point in time on which you can sign up. Some companies do ask that you sign up for Part A. That's your hospitalization. You've already paid for that within your working years. No need to worry about that. Part B, Part D. Part B is going to be your preventative care, doctor's visits, lab results, things of that nature. Part D is going to be pharmaceuticals, prescription drugs. You're typically not going to be asked to sign up for those. If your employer does, then I would have a long talk with your benefits group to make sure that that is the right move, because you will incur additional cost on top. Generally speaking, though, it is only Part A if they do ask you to when you're over 65. Make sure you get this right. There's a 10% penalty for every 12-month period you don't, and you can forfeit your guaranteed insurability period, meaning that they can decline you or jack your premiums up on Medigap, which we don't want you to incur. So make sure you're talking with your group. Understand the ins and outs. There's a lot of pros and cons. Most people stick with their employer plan. That's just the way it goes. It's typically going to be a little bit cheaper, typically better coverage in the interim before you have to jump on Medicare. So moving right along.
We had a question about as a high income earner, 30 years old, can't contribute to a Roth IRA. Should he contribute to the Roth 401k?
Yeah, absolutely. I mean, so I think it depends. It's contingent on what type of other assets you have. Number one, building that foundation, making sure you have enough in an emergency reserve, any short-term needs. Like if you're 30, you're going to buy a home, setting aside funds for that. But, we have to believe at some point, if the government continues to spend money the way that they do, we're going to see higher taxes at some point in your lifetime if you're 30 years old. It's going to be a very interesting scenario if they can get their way out of this. So you're the revenue producer. Even though you're probably in a higher tax bracket now, I would probably lean on putting more in that Roth 401k because it's going to give you a whole lot more flexibility in the future. Plus, you're not going to have those assets compounding in an account that every dollar you pull out from that traditional 401k is going to be taxed. at ordinary income rates, which we don't know where they'll be. So I like maybe hedging your bets, playing the game a bit. Another scenario we see with a lot of high income earners that are younger, they're maxing out a Roth or a Roth 401k, or they can't put into the Roth IRA because they make too much money. They've got all the other money they've set aside. They look at a permanent life insurance policy with a very small death benefit, overfund that to really grow that cash value.
Tax-free.
And then utilize that tax-free if you keep it under what they consider a modified endowment contract. So we try to keep the death benefit low. You don't use this to mitigate risk. You're using this for the asset accumulation aspect. So if we keep the death benefit low to a specific amount, and where we'll say, hey, you've got an extra $5,000 a month you want to put into it, you can fund that, kind of supercharge that. And then essentially instead of taking a withdrawal, you take a loan. There's a lot of nuances to it, but that is a tax-free way to take funds out, get growth over time, and kind of play the game of creating, you hear be your own bank. Well, that's how a lot of people do it.
Right. And but again, and there's also too, I run into this a lot, is you have high income earners. They're young, they're high income earners, but their company doesn't have a lot of contributors to their 401k plan. So the high income earners, typically the owners or the executives of the companies, they're limited on how much they can actually contribute to the 401k plan. They can't do the full $30,000 a year because they're income limited. So that's where something like a whole life insurance policy or some other things can be implemented to kind of bridge that gap between what you can actually contribute to a plan or because you're limited out of an IRA, whatever it is. There's some other ways to kind of bridge that gap.
Yeah, if you're a key employee, if you're highly compensated, there are safe harbor rules. So if the majority of your the other employees aren't contributing much or not contributing at all, they could potentially send you a check back. We know a lot of people that actually get a check back in the new year, and they say, "Oh, well, these funds are taxable. Here you go. Merry Christmas, Happy New Year." So certainly ways to do that. I wouldn't necessarily bank on that aspect of it though, because every year those numbers can change. I've got a buddy of mine who calls me once a year and says, "Hey, you know what? This year I got X amount back. Last year was this." So it's very tough to kind of plan for that. Yeah. But if you can do so outside of it and ahead of time and say, all right, this is kind of what we typically see, and then you can start backing into other numbers.
Yeah. And again, there's Scott says, use a SEP. SEPs are fine, but you've got to be self-employed. If you're working for another company that has a 401k plan that you're contributing to, you can't really do a SEP because you're not self-employed. So, there's the issue is there's limitations to all these things, right? So as long as you're within the right setup, then you can take, there are tools to use for each one of these things, right? So just depending on your situation, this is why financial planning is so important, is to look at your situation and say, what are the best ways that I can save and invest and save on taxes, right? That's the whole goal.
And self-employed individuals, there are so many new nuances that are out there and things that are available. So Secure Act 2.0 kind of opened the landscape for broader planning in many ways. Yep. So you could even do a Roth and a SEP IRA. Now, this is typically going to be for a small business owner. Typically, you don't want, employees are going to be 1099. W-2 employees, you would have to contribute that same amount you're contributing from a percentage perspective to them. So we have to be mindful, how much do you really want to do? 401k may be a better option, but certainly things that you can do that are not, SEPs up until a couple of years ago, you could only do pre-tax. Now we're seeing that element. And so we get back on that conversation where we see everybody saying, oh my gosh, they're going to do away with the Roth. Well, they're making Roths that much easier because the government needs your money now.
Exactly. Like J.D. Wentworth. Someone in my 70s, should you sign up for Medicare Part A? I need to know the answer to this question, being that I'm older than dirt. Is it time for me to sign up for Medicare Part A?
You're not 70, number one. You're not 65, number two. No, so
I feel it. Is there an emotional age that I can sign up for Medicare?
No. No. And the funny thing is that a lot of times we do hear that emotional aspect too. And in fact, I'm visiting with somebody this week who family said, oh my gosh, you have to sign up. And you do the numbers, run the math, and it's like, wait a second, you don't. We found out you are on a creditable plan. I would certainly delay at the moment. And I think that there's no one size fits all. So you have to be aware of your situation, and you may be retired or not working, but your spouse may still be working. So even if you're on a spousal plan, you can still remain on that plan and not get on Medicare, assuming it is a creditable plan. So I don't think that, we don't want to look and be very cautious when you have friends and neighbors or family saying or suggesting this is something you have to do. There are some hard rules. There's no doubt about that. But same goes for Social Security. We see too many emotional decisions surrounding this, and I get it. Medicare is the alphabet soup, but take a step back. Number one, you cannot sign up unless there's a disability if you're under 65. So you have to be 65. Yes, you could get off of your plan and sign up for it, but your current plan is likely being subsidized by your employer. So you may not want to do that. And the other caveat with this is that we need to make sure that you're spending the time to understand exactly what you can and can't do. There's a lot of talk and a big push on Medicare Advantage. I would be extremely cautious. While Medicare Advantage has really grown in a lot of good ways, where it used to be all HMOs, closed-in networks, now we're seeing more PPOs offered. Be cautious with this because you may have to get approvals to see specialty doctors, which can take some time. Which unfortunately, if you're diagnosed with something that is, highly, it's moving very rapid, you don't have that time potentially. So I always encourage, if you can afford it, I would certainly entertain original Medicare over Medicare Advantage, but just be very careful because that Medicare Advantage there's a big push. Mm-hmm. I mean, you'll be getting those mailers before too long, Lance.
Yeah, no, trust me, I already get the AARP ones and the AAA and you name it, right? I just had, the ones I haven't got yet. What? I haven't got the senior citizen discount yet, right? That's the one I'm waiting on.
Well, you know what? It goes back to what you were talking about earlier. It's all the Botox you've done, all the GLP-1s.
Oh.
And,
yes.
Because Lance doesn't even work out. He's
exactly.
like he's a bionic man. I mean, this is all modern
fake.
Medicine right here.
This is all plastic surgery and robotics and all that. Yeah, absolutely. I never ever go to the gym. Ever. I think hey, there was actually a pretty good analysis the other day that like this guy lived to be like 150 years old. So he was like really old and like never worked out a day in his life and all that type of stuff. And so the comment was, if you live that old, why am I working out? Right. So
yeah,
maybe the preservatives work.
Well, hang on real quick. So there's a couple more questions on Medicare.
Yeah.
Scott from, let's see, what did he say? So you're right. You do have so there's two real big periods of time that we want to make sure you get it right. You have your general enrollment period, which is a 7-month window. So when you turn 65, you have 3 months prior to the month of your birthday that you can sign up, and then 3 months after. So that equals 7 months. If you're not working or you're not on a plan, it is extremely important that you go and you sign up. If you are, then you have your special enrollment period, which is at 8 months if you're going to continue to work or covered on a spouse's plan after age 65. Scott, you also mentioned COBRA. COBRA does not qualify as a creditable plan, even though it feels and looks like your employer plan. Medicare does not look at that as such. So you may get this window that's going to take you out of the window, that 8-month period that you have, or past your 65th birthday for that 7-month period. Be extremely cautious. Go ahead and get your ducks in a row. If you get out of that window, that's when we can start racking up that penalty and start seeing problems. And we don't want you to lose that guaranteed insurability clause. The other caveat is if you're signed up, I've seen people sign up at 65 and then they go back to work. They want to get back on an employer plan. Do not do that because that guaranteed insurability clause is one time. So make sure you're not jumping back and forth because you could come back to Medicare and you could get a really big surprise, which would not be great.
Yeah, exactly. There was one other question about getting off COBRA. I just got off my COBRA and went on to Medicare. It's much less than the COBRA payments.
Yeah, I mean, a lot of times it is. I mean, COBRA payments are expensive. Health insurance. I mean, Lance, if I was looking at our numbers on what we pay as a firm,
it's crazy.
It's ridiculous. It's a humongous expense how much health insurance is. And we can shop it. I mean, it's crazy. So, getting off of COBRA and onto Medicare. So it's a great way if you're pre-65, bridge the gap with that. It's probably better than going out and doing the Affordable Care Act, right? Especially if you're a high income earner, you're not getting much subsidies or any at all. So COBRA may be better than that, but then certainly look at jumping on Medicare, Part A, Part B, Part D, and then obviously your Medigap, which is going to fill in the holes of that Swiss cheese, so to speak, of actual Medicare. Oh, let's see. What else you have here, Lance?
I think that's about it.
Okay.
I think we're running out of questions here.
Wow, that's impressive.
No, I appreciate it very much, Danny. Thanks for helping out this morning. All right, we'll wrap it up here for today. Be back tomorrow with Michael Leibowitz, touching on kind of what's happening this week and kind of looking at what happens next potentially. So again, we'll get into all that with Michael Leibowitz tomorrow right here on the Real Investment Show. Be sure and give us that thumbs up because again, that thumbs up really helps us a whole lot more than you know. So if you'll just hit that like button, we would really appreciate it very much. It does help us with the algorithms. And of course, we'll be back tomorrow with Michael Leibowitz. Be sure you're by the website, realinvestmentadvice.com. Michael Leibowitz's new article is out today on the website. I've got a really interesting one coming out on Friday as well. So again, we've got constant commentary for you on the website, or newsletter, daily market blogs, daily market commentaries. Subscribe for them. They're all free, mailed right to your email box every single day. Or follow me on Substack. I post there as well, at Lance Roberts on Substack. Follow me there, and you can get all of our written commentary every single day. All right, we'll see you back here tomorrow on the next Real Investment Show. Have a great day.